Interactive Brokers has this very useful feature called the Dividend Reinvestment Plan or DRIP, which automatically helps you to reinvest your dividends and by doing so, activate the magic of compounding. However, given that IBKR charges a minimum of 35 cents per trade, wouldn't DRIP be not worth it? If it reinvests your $10 dividend, wouldn't you be paying the equivalent of 3.5% fee, which is like super duper expensive? The short answer is no. That's because IBKR charges a totally different fee for reinvesting your dividends. In this video, we will go through what DRIP really costs, all the things you need to know before turning on DRIP, and most importantly, should you even use it? Let's not waste any time and let's jump right in. Now, contrary to popular belief, the actual fee for IBKR's DRIP isn't the usual 35 cents. Instead, if you go all the way down to the bottom of the pricing page, IBKR has this tiny line which says that on a tiered plan, dividend reinvestment is charged at the lesser of 35 cents or 0.1% fee of whatever you are reinvesting. So what this means is that on the tiered pricing plan, if you were to reinvest $10 worth of dividends, it will only cost you 0.1% of the amount, which is basically just 1 cent. This 0.1% fee will keep going up until it reaches a maximum of 35 cents. So if you are reinvesting $3,000 worth of dividends, it will mean two things. One, you are an incredibly rich guy or girl, and two, the fee will only be 35 cents, which is not even a price of a bowl of white rice. But what if you are on the other pricing plans like fixed pricing or IBKR Lite? In that case, the fee would differ slightly. Referring back to the fine print again, if you are on the fixed pricing plan, the DRIP will be subjected to the lesser of $1 or 0.1% of whatever you are reinvesting. So same thing, if you are reinvesting a small amount like $100 worth of dividends, you will only pay 10 cents worth of fees. And this fee will keep going up until you hit a maximum of $1. Otherwise, if you are on IBKR Lite, US exchange listed stocks and ETFs are commission free, reinvestment included. Wow, so good ah. Yes, so good. But just note that IBKR Lite charges higher fees for non-US markets, has higher margin interest while giving you lower interest on your cash. So that's the trade-off. But then, here's another question. Does reinvesting your dividends change how much tax that you pay? The short answer is no. Reinvesting dividends doesn't change your tax at all. So if you are from Singapore, the usual 30% dividend withholding tax will still apply. Meaning, before you even receive your dividends, Uncle Sam will slap away 30% of your dividends, and you receive only the remaining 70%. Though, the good news is that dividends received in Singapore aren't taxed. Meanwhile, if you are from the US, your qualified dividends are subject to a 0%, 15% or 20% tax rate, depending on your level of taxable income. By now, some of you will probably be like, wow, the fee so cheap, tax also no difference, so what's the catch? And is DRIP even worth it? I personally believe that there's no catch at all. If anything, this is a fantastic feature for most long-term investors. That's because you get to put your investing on autopilot. Your dividends go straight back to work immediately and you don't even have to do anything. Besides that, another small benefit is that you get to enjoy lower fees than if you have done the reinvesting yourself, especially if the amount reinvested is small. However, with that being said, I can think of two cases where someone might not want to turn this on. The first one is if you are someone who prefers to have full control over your investments. In that case, you might not want to use this. For example, maybe one of your holdings has been lagging behind the rest. So rather than automatically reinvest your dividends back into whichever stock that paid it, you probably want to deploy the dividends into the stock that is lagging. That way, you get to slowly rebalance your portfolio without having to sell anything. The second scenario is maybe you feel that the stock has run too far ahead and you don't want to invest at the moment. In that case, you can just keep the dividends as cash in your account while you wait for the right moment to invest. And the nice thing is that while your cash waits to be deployed, it can still earn you some interest. Though, do note that IBKR pays nothing on your first $10,000 of cash. So on a small dividend, you won't actually see any interest. So whether it's worth it or not totally depends on your use case. Now, if you have decided you want DRIP on, here's how you can do it. On the app, open up the settings menu on the left, tap Settings, Account Settings or Account Settings. Then look for Dividend Election. Here, you'll be able to choose how you want the payout to be handled on the account level. And if you want to, you can also set a different payout option for each individual stock in your portfolio. Take note that DRIP only works for US, Canadian, and Europe listed stocks, so stuff like your SGX stocks won't be eligible. Oh yeah, in order for DRIP to work, you also need to enable fractional shares. To do that, head over to the settings menu again, tap settings, trading settings, and tap trading permission. Tap on stocks and scroll all the way down till you see global trade in fractions. Make sure it is enabled and hit save. Then the next time you receive a dividend, IBKR will automatically reinvest for you on the next trading day. So there you have it. That was a quick look at IBKR's dividend reinvestment plan, what it costs and whether it is worth turning on or not. Anyway, that's all for this video. Hope you found it useful. Like, share and subscribe as I'll be posting new videos every week.